Good afternoon and Happy New Year. My name is Chris Andrews, Vice President and Head of Funds Management here at Trobe Financial, and we're pleased to again welcome a large number of people from across Australia for our first quarterly investor call briefing for 2015. So today we intend to cover the following topics. First, domestic and international macroeconomic issues and their impact on your investment performance. We'll focus in particular on some really key economic indicators and drivers this quarter, and this section will incorporate, of course, our much discussed headwinds and tailwinds report. Secondly, we'll give you an update on the La Trobe Financial Group, and thirdly, of course, we'll focus in on how our retail investment fund in particular has performed for its investors, which is always a topic of great interest. Now you should be able to see on your screen where you can type in questions. Obviously with the numbers we have attending today, we mightn't be able to get through all of these questions during this half hour. We'll answer questions on a first come, first served basis. If there are any questions we can't get to for time reasons, then we undertake to follow up with you personally after the teleconference, as we always do. We note that in this forum we can't comment on individual assets or investments today, but our investor team is as always standing by, ready to assist you on these matters on 1800 818 818. We've got plenty to get through today, as we always do. We appreciate you're all on very tight schedules, so we'll keep this presentation to half an hour maximum. So let's get started. First, our headwinds and tailwinds report. Particularly as we moved into 2015. And speaking broadly, the themes that drove discussions in the second half of 2014 will continue to drive discussions into the first half of this year. And we have to say, as we have so often in recent years, an objective reading of the most basic economic data presenting our economy, it presents a more optimistic view of our present situation than the more alarmist predictions that you sometimes hear would suggest. At a high level, yes, we face challenges, of course we do, economies always do, but there are a lot of reasons to be positive about what 2015 could bring for the Australian economy and for investors. Turning first to the headwinds, those things perhaps acting as anchors or hindrances to the performance of the economy in 2015, we're going to single out the big three today. First, unfortunately, we're still seeing no signs of resolution of Australia's government budget crisis. The situation can be put pretty simply. You have your receipts or revenue and you have your payments or expenditure. Since the turn of the century, receipts have grown steadily in absolute terms, with the exception, of course, of 2 years during the global financial crisis. However, as a percentage of GDP and for a variety of reasons, Commonwealth receipts have not recovered to pre-GFC levels. Now that's unsustainable in the light of Commonwealth government payments, which have grown steadily throughout the period, both in absolute terms, as the graph on screen shows, and also since about 2007 as a percentage of GDP. Our governments cannot sustainably, into the long term, be big spenders and low taxes. Trying to do so has two consequences. First, the long-term sustainability of our social infrastructure in the widest sense of the phrase is threatened. Deficits today are simply tomorrow's bills for our children. Secondly, the inability of a government to maintain fiscal discipline can destroy the confidence of our investors and consumers, and that in turn has disastrous impacts for employment and economic activity generally. Now obviously it's not our place to recommend specific policy prescriptions, we leave that to the politicians. We can only repeat the urgency of the current situation and how important it is that we demand that our representatives address these problems. The second headwind, domestic growth. The latest official ABS figures have Australian GDP quarterly trend growth at just 0.3%, which is a miserable 1.2% annualised, of course. That is a change from last year when above-trend growth was being recorded. Now, there are those who question these figures. After all, if the Australian economy is below trend now, given interest rate settings, given the strength of our major trading partners, then we are in a world of difficulty. And there are two of the three growth measures that are averaged to give the official growth figures, those two being expenditure and income, which are recording at or above trend growth. Could there be a problem with the third leg of the statistical averaging, which is the production statistics, which bizarrely report falls in public spending and construction? But with that caveat and in relying on the official statistics, growth has to be down at this point as a distinct headwind. The third headwind, international growth. And as a highly trade-exposed nation, Australia's economy is significantly affected by the performance of international markets. And at the moment, the world is a long way away from the boom conditions that we've enjoyed in the recent past. Our key trading partners continue to perform well, but are slowing. China in particular is the subject of a lot of commentary. Its most recent GDP figures for 2014, which were released just last week, showed fourth quarter GDP at just 1.5% growth, with 7.4% growth recorded for calendar year 2014. Now, this level of growth for an economy of this size is still extraordinary, but it is the lowest calendar year growth in China since 1990. Now, we've been reminding our investors that this sort of slowdown is inevitable as China's economy matures and switches from investment to consumption. So perhaps the more substantial challenge for China will continue to be the demographic challenges that it faces with a declining, in terms of number, and more expensive, in terms of labour cost, workforce. Europe, of course, is still a substantial drag on the world economy, and the European Central Bank's decision to launch a €1 trillion bond buying program underlines the seriousness of the situation that they continue to face. We should note, however, that there have been predictions of a Eurozone disaster for the last 7 years now, and so far they've managed to muddle along. Japan's growth, well, that plummeted, but that was sort of not unexpected. There was an increase in its sale tax settings, and it was expected that this would result in at least a short-term hit to GDP. So it's probably sensible to wait a quarter or two before drawing too many conclusions about the sort of medium-term trajectory of Japanese growth. On the other hand, the US economy is in a much stronger position and looks to be the real bright spot in the world for 2015. If you, for example, just focus on unemployment rate, you see the magnitude of what is going on over in the United States. So that's a real positive for the world generally and for us here in Australia, as you can see from the graph on screen. Down from 6.7% unemployment early last year down to 5.6% at the latest print. So aggregating all of that, we're not talking about obvious and imminent disasters around the corner as far as world economic growth is concerned, but we are facing a period of uncertain and sluggish international growth on average. Turning now to the tailwinds, those factors that drive Australia's economy and potentially drive performance for investors. The first and most obvious tailwind continues to be our record low interest rates. This quarter, I'll resist the temptation to make bold predictions about the future of interest rates. Suffice it to say, interest rates remain exceptionally low. Many economists who were predicting increases this year have backed away from those predictions, and in fact, many pundits are now tipping that the Reserve Bank's next rate adjustment will be downwards, and that perhaps as soon as this afternoon. Now, this is good for economic growth and for borrowers, and so is down as a tailwind for the purposes of this analysis. However, we are always conscious that there is substantial downside in low interest rates for those investors who are looking for yield, and we at Trobe Financial remain extremely conscious of that fact. The second tailwind is our exchange rate. And after spending the last 6 or so years at historically high levels, the Australian dollar has now moved decisively downwards. The effect of this is to make our exporters in industries across the economy like manufacturing, mining, agriculture and tourism more competitive. Now, this is a substantial tailwind for those industries and will assist in rebalancing the economy away from mining investment. As usual though, watch for the downside as imports become more expensive and potentially drive inflation upwards. In our last investor call briefing, we discussed in some detail the difficulties being experienced by the ABS, the Australian Bureau of Statistics, in reporting on unemployment rates. Now, it's clear that the raw data is flawed on a month-by-month basis. Our premise is that by looking at the data over a longer term, what you can actually do is screen out some of the noise and get a sense of the trend. And I'm pleased to say that so far at least we have not seen the dramatic increase in unemployment that many have been predicting. Indeed, with the latest print at 6.1%, we're almost at the same level as we were 12 months ago. Now, given the uncertainty we faced, the negative commentary that's been received on this topic, we can only view that performance as a tailwind for the economy. A substantial tailwind, of course, comes from the surprisingly low inflation print that we've seen, with headline inflation dipping below the RBA's target band for the first time in nearly 3 years. Last Wednesday, in fact, the ABS reported that CPI, the Consumer Price Index, grew just 0.2% quarter on quarter, or 1.7% year on year. Now, this was substantially lower than was expected and reflects to a large extent, we believe, the sharp drop in the price of oil, which we'll talk about separately in a moment. The effect of this low inflation print is to free up the RBA to make further reductions to interest rate, which would of course add further stimulus to the economy. Finally, turning back, as I said I would, to petrol prices, they're worthy of some discussion in themselves as a material tailwind for the Australian economy. Those with, shall we say, reasonable memories might recall the days immediately pre-GFC when petrol prices were soaring to then unprecedented levels of $1.70 and $1.80 a litre. A combination of events since then, including lower than expected demand and the advent of alternative sources of supply, means that this equation has reversed dramatically, particularly in the last few months, as the graph on screen shows. The Australian Institute of Petroleum is now recording a retail petrol price slump of around 50% over the last few months. Now, this was predicted by virtually no one, and it has the same effect on the economy as interest rate cuts for the average Australian. On the back of this decrease in petrol prices, we can expect to see increased consumer spending and genuine grassroots level stimulus. So a really great tailwind for the economy. So that's the headwinds and tailwinds report, and we repeat, the picture is certainly not all doom and gloom. It is important for investors to remember that economic performance is not the same thing as market performance. But over the longer run, the fundamentals of economy do influence your investment outcomes. So we turn our attention now to the Trobe Financial Group, and the December quarter was a very pleasing one for the group and our investors. In terms of awards and ratings, it was a stellar quarter for the group. On Tuesday, 18th of November in London, in the UK, the renowned International Finance Awards were held. Now, this black tie invitation-only event was held at the exclusive Jumeirah Carlton Towers Hotel in central London. It was attended by over 200 people covering global financial institutions, banks, investment managers, insurance companies, representing 92 countries across the world. Amongst that prestigious company, Trobe Financial stole the show and picked up 2 awards. The first was the very prestigious Best Investment Management Company Award, and the second was Best Mortgage Fund in Australia. So that was really a really outstanding result for the Trobe Financial Group. Then on the 6th of December, the prestigious retail financial journal here in Australia, Money Magazine, judged the pooled mortgages option to be the best mortgage fund in Australia. This was the 6th consecutive year the pooled mortgages option has won that award, and we were really pleased here at Trobe Financial to receive it. We can also confirm that the fund and its pooled mortgages option maintained their independent ratings over the quarter. We're really pleased to be able to announce that SQM Research has in fact now upgraded the pooled mortgages option rating to 4.25 stars or superior. Now, whilst ratings are only one factor to consider when investing, we are very committed to the ratings process, primarily because of the accountability and the transparency that engenders in us as investment managers. So the SQM report and our other ratings papers can be viewed on our website at latrobefinancial.com.au. Finally, I should mention that Trobe Financial has also been listed as a finalist for the RFI Australian Lending Awards in the category of Best Specialist Lender that will be announced in mid-February. So all fingers crossed, and we're very much looking forward to those, and I'll certainly update you those in our next investor call briefing. The work that sits behind these achievements was phenomenal, and there were some outstanding achievements at an operational level in the Trobe Group over the December quarter. We had $660 million worth of originations in the December quarter, with settlements of over $100 million in each of the 3 consecutive months. We're really pleased to have the broadest product offering in the market now across the residential and the commercial sectors, and we've got a host of new product initiatives that we'll be launching in the coming days to assist both our borrower and our broker clients. So all very positive there. In terms of distribution, another very busy quarter. In October and November, we presented to investors with the Victorian State Government in Kota Kinabalu and Kuala Lumpur in Malaysia Also in Singapore and Jakarta. We were very pleased with the level of interest and support we generated through these presentations and also our ongoing relationships with the Victorian State Government. Our Senior Manager Client Partnerships also attended the FPA conference in Adelaide in November. Obviously we are an approved investment on around 100 licences representing literally thousands of investors across Australia. So these conferences are a great way to catch up with a large number of clients in a very efficient way. And finally, as we mentioned in our last teleconference, we conducted our annual Professional Placement Scholarship Program, welcoming a group of rising star Chinese executives from some of the world's largest financial institutions, showing them around the Australian financial system, the Australian economy, and also just life in Australia generally. Really successful program. At a financial level, all key metrics continued to build through the quarter. Funds under management in the retail fund grew to 860 million, or 2.1 billion on a group-wide basis. So all in all, a very, very strong set of numbers. Now in our last teleconference, we sat down with Randall Williams for the first half of a discussion on La Trobe Financial's international strategy. In particular, we discussed La Trobe Financial's China strategy and our professional placement scholarship program. Today, as we promised, we're pleased to have Randall back to continue the discussion. Today focusing on the much talked about significant investor visa program. Good afternoon, Randall.
Good afternoon, Chris, and good afternoon, everyone.
Now, Randall, the significant investor visa has been attracting a lot of attention and commentary. Can you explain briefly what it is and how a foreign resident would apply for it?
Yeah, sure. The significant investor visa, or SIV as it's commonly known, was introduced by the Australian federal government in November 2012, so a couple of years ago, to encourage people from other countries to obtain permanent residency status in Australia using a really simple, streamlined method. The SIV requirements are actually very simple. To obtain an SIV, a person needs to invest $5 million in complying investments, and I'll talk more about that later, in Australia for 4 years, reside in Australia for 40 days each year, so a maximum of 160 days, and at the end of the 4 years they can actually apply for permanent residency. Unlike a lot of other visas, applicants don't have to satisfy the traditional visa requirements such as innovation points test, language test, or the upper age limit. The applicant is sponsored or nominated by one of the Australian states, and then the visa itself is issued by the Australian government. So applications are a two-stage process: nomination by a state government and then approval by a federal government. The provisional visa is called Visa 188 and the permanent visa is called Visa 888. So for those of you who are familiar with Chinese numerology, you'll know that 8 is a lucky number for the Chinese. So it's perhaps not surprising that the visa is largely targeted at people from China.
Thanks, Randall. What's the uptake of the significant investor visa been like? Are there any statistics available showing how many have been granted, for example?
Yeah, sure. SIV started with a bang and has slowed down a bit last year, but the Department of Immigration and Border Protection regularly provides statistics, and the latest figures show that there have been a total of 595 SIVs issued so far, which, when you think about it, represents an investment in Australia of nearly $3 billion. So $3 billion over 2 years of new investment into Australia. And there are about 2,000 expressions of interest currently in the pipeline. The majority of the applicants have been nominated by New South Wales and Victoria, with Victoria being the most active in the area. Certainly the State Government of Victoria has a real commitment to this program. And not surprisingly, over 90% of the temporary visas issued so far have been issued to Chinese nationals, with the majority of the balance being issued to residents from Southeast Asian countries. While there was a lot of activity when SIV was first introduced, the level of activity has subsided somewhat, perhaps because the Australian government has announced a review of the program, and people may be waiting to see the outcome of that review before taking the next step and applying. For example, SIV approval slowed during November of last year, with just 27 investors of 27 visas issued in total.
And has Latrobe Financial received any significant investor visa investments?
Yeah, sure, Chris. We've been quite actively in the SIV market. As I mentioned before, the $5 million has to be invested in complying investments. Now, there's a list of complying investments. They include government bonds and managed investment schemes. And this is where Latrobe Financial comes in. Our award-winning mortgage fund is a complying investment for SIV purposes, and we've received a number of SIV investors, some of whom have invested the full $5 million in our fund, while others have diversified their investments and placed only part of their $5 million with us. So there's a balance between full commitment to $5 million and to a certain extent diversification by the SIV investor in its investment strategy. What we've found with our investors is that one of the attractive features of the fund for SIV purposes is that the SIV applicant can invest in our pooled mortgages option at first, and then as they become more familiar with investing in Australia, they can then start using our select mortgages option, which allows them to choose the individual mortgages in which they want to invest.
Thanks, Randall. You mentioned that the federal government has commenced a review into the SIV program, if I can call it that. What is that review about, and what do we know about what the likely outcome will be?
One of the things about programs of this nature is that many other countries offer similar programs. So what the federal government has decided to do is to review the SIV program, perhaps making some changes to that, as well as introducing a new premium investor visa class. You'll recall that the basic SIV visa calls for an investment of $5 million for 4 years. This new class of visa, the Premium Investor Visa, or PIV as it's known, is to be introduced, offering a quicker 12-month pathway to permanent residency for those meeting a $15 million threshold. So it pays to be rich if you want to get permanent residency here in Australia. You'll also recall that the states were the sponsors or nominating entities for SIV purposes. Into the future, the federal government wants Austrade to play a greater role in the program, so it's going to be a nominating entity for SIV, and it will be the sole nominating entity for the Premium Investor Visa, so Austrade's going to play a bigger role. The government's also going to review the complying investment regime, and this is expected to change with venture capital and private equity funds and investments expected to be included in the categories of complying investments. Austrade's been seeking industry feedback, and Latrobe Financial, Chris and I, have been working with the Financial Services Council of Australia in giving Austrade its views on how SIV and PIV should work into the future. One aspect that the government wants to focus on in terms of complying investments is to encourage the investments to, if you like, go to work in Australia. Perhaps there's been too much emphasis on investing in government bonds, and so as a result of the review, perhaps the aim is to provide capital to areas of investment that have been insufficiently supported in the past, hence venture capital and private equity being included as complying investments.
And Randall, just briefly, do you have any other thoughts on the SIV program, any likely shape, or how companies are reacting to it, in particular Latrobe Financial?
Yeah, our view is that it's really something that we have to wait for to see what Austrade comes out with its report. So from our point of view, I think the message is watch this space. We expect the Austrade review to be made public in the next couple of months, and we'll provide an update then. From Latrobe Financial's point of view, though, it's really business as usual. We'll continue to market our fund to potential SIV investors. We're very proud of our fund. We think it's a great fund, and we think it's an excellent opportunity to introduce international investors to Australia. But the thing is, the strength of our position here is that our fund is well supported by Australian investors, and it continues to grow strongly. So from our point of view, SIV is really icing on the cake, if you like.
Okay, well, Randall, thank you very much for that update and for your time. It's very much appreciated.
Welcome, Chris, thank you.
So we turn now from the significant investor visa. We'll focus in briefly, conscious of time, on the fund's performance for our retail investors. And I start, as I normally do, by confirming that our pooled investment options, the cash and mortgages and the pooled mortgages options, they continue their proud history of never freezing redemptions and never returning a cent of loss to their investors. Both maintain strong distribution rates, and the flagship pooled mortgages option is now at 405 million in funds under management. Our peer-to-peer options, as we've said in the past, continue to see a lot of activity, and in particular from the self-managed super fund sector and across a range of loan types. So really pleasing activity from a whole diverse range of sources there. In terms of performance, well, the December quarter average returns of the CMO and PMO, the cash and mortgages option and the pooled mortgages option, generated healthy returns over the benchmark. For CMO it was 1.5% per annum, and for PMO it was 1.78% per annum. The CMO's benchmark is the official cash rate, which is the best proxy for its performance profile over the time and the most relevant comparator for investors. The pooled mortgages options benchmark is the old UBS Bank Bill Index, which has now been renamed the Bloomberg Ausbond Bank Bill Index, which is a common benchmark for cash-correlated fixed interest type investments, plus a margin of 1.5% reflecting the risk-return profile of the pooled mortgages option. Longer-term performance of both options continues to be very strong, certainly reflecting the strength of our investment philosophy in what appears to be, as we've said, an extended period of historically low market interest rates. Graphically, we can see the pooled mortgages options return against various 12-month term deposit indices on screen. Over the quarter, PMO slightly increased its margin over the average 12-month TD rate of the big four banks, which is the black line there. Extremely powerful performance for investors, although we note, as we always do, that neither CMO nor PMO are bank deposits. They are not subject to the federal government deposit guarantee, and as usual, past performance is not a guarantee of future performance. In the same spirit, we have on screen now the CMO's returns in comparison to key online account indices, so solid, reliable performance in there. Putting the PMO's returns in particular in context, we turn to comparative annualised returns since inception. The other asset classes considered are Aussie equities, property securities, global equities, Aussie fixed interest and cash. The PMO is the orange line running straight through the middle of your screen. As we frequently point out, whilst each investment type has its own merits, this picture encapsulates what we're trying to deliver for our investors, and regular low volatility income it is that's uncorrelated to other markets. And of course, if you look at that on an accumulation basis, that sort of performance produces a very strong absolute return profile. So to summarise, it's business as usual. The post-GFC world is one in which generating above-trend growth is going to be difficult both for developed countries and developing economies. However, there is nothing that should lead us to lose confidence in Australia's outstanding long-term economic prospects. At a company level, we at La Trobe Financial, we continue to be 100% committed to our financial stability and sustainability. We will remain inextricably and irrevocably client-focused, both for our investors and for our borrowers. Nothing is going to dilute that focus. Our balance sheet is strong, our funding base is diverse and growing, and all leading indicators are positive. Our fund is continuing to deliver powerful, stable returns for its investors. So on that note, in the time remaining, I'd like to address a couple of the questions that have arisen. We have one question from Ian asking about origination levels, how origination levels have compared with recent quarters, and the answer, in short, Ian, is that in the recent history, those origination levels are really strong. They're at the upper end of what we've produced. They're perhaps not historical levels for the group as a whole. There was the pre-GFC period when we experienced similar and perhaps slightly higher levels, but certainly since the GFC, they are very, very strong. and right at the upper end. So it's been pleasing because those levels of originations have been generated without any compromise to credit quality. So that's been a really important focus. I know Ian's got another question or two, and we'll come back to that if there's time, Ian, but in fairness I'll just move on and answer one other question. I might follow up with you, perhaps Ian, separately at the end. We have a question here from Penelope, and Penelope is asking about house prices and whether they're too high. Well, in short, it's hard to see too much change in the house pricing environment since since we discussed this issue in the teleconference in October. And in a nutshell, we've had booming construction levels of new houses towards the end of last year, recording sort of the highest levels we'd seen in 20 years. However, that level is still trailing demand. We've got household savings levels still at generational highs. We've got low interest rates for the foreseeable future, as we've discussed. We've got no signs of mortgage stress levels increasing. All this suggests that house prices are not in a bubble, but we are simply facing an affordability challenge. And that, of course, was the reason, as we've previously discussed, that Trobe Financial was really pleased to launch our P2C, parent-to-child product, squarely addressing that affordability challenge. If we look for the year ahead, well, it's hard to see too much changing across Australia. Perhaps you'll see Sydney's really, stellar growth levels of the last 2 years. Perhaps they'll moderate somewhat, but they're still probably going to remain very high, perhaps in the sort of high single digits or maybe low double digits level even. So still very strong. Rest of the nation, broadly more moderate with, of course, as always, individual local markets with significant upside potential. Now, we do have a range of questions, as I said, from Ian, from Peter, from John, from Ratner. We will I'll address those separately, but for now, that's all the time we have today. Very much appreciate your interest in our investor call briefing. We will contact those with outstanding questions. We will contact them separately to discuss, but for everyone else, we want to send you on your way promptly and on time. So happy investing. We look forward to your company at our next investor call briefing. Thank you very much.